All right, welcome back. So, we're gonna do a little things a little differently today. So, when we learned periodic inventory, right? We learned that sales was dealt last. It was part of the last thing that we had to deal with, right? We ended up working with the inventory worksheet before we got to take a look at sales. Reason being is because I want you to understand that when we deal with sales, it doesn't affect periodic inventory purchases at all. All right, I wanted you guys to understand that main part and that the sales was always dealt later because at the end of the day, it doesn't matter because we don't keep track of sales. Well, now we're learning about perpetual inventory, and we're going to be focusing on sales because, again, when we deal with perpetual inventory, not only are we constantly updating our inventory with purchases, we are also updating our inventory with sales. Okay? So no matter what it is, no matter what we do, we are always going to keep track of it and we're always going to take it right out of our inventory immediately. So in this case, again, we're going to review the little sales section here. So again, sales is the nature of a business, as we all know. Our main purpose and goal of businesses is to take our resources, create a product, and ultimately turn that product into a good or service and to sell it, but mainly to make money. Now, of course, when considering the selling price, we need to also understand that the selling price must include at least the cost of must include all costs to get the item to the store. Okay, and we also have to do a little profit percentage because at the end of the day, we never want to sell a product and break even. We always want to make a profit so we can cover our other costs of doing business, right? Our operating expenses, and we also want to include all of those above. So usually that is going to be determining what the selling price is. You want to have some kind of percentage of profit. Okay. And of course, when we're dealing with making a sale of an item, we're going to be dealing with sales tax. And again, it just depends on what your county is and what state you belong in. So for this class, I want to just focus on a very simple number, 8.25%. Okay. Right now, the sales tax for Nevada in Clark County is going to be a little different. Okay, it's a little higher. Okay, so again, we talked about how sales work, and in this case, here's a little example here. We understand. Okay, so on June 1st, 10 toys were sold at $9.99 each. Sales tax was 8.25%. Okay, so the toys were originally purchased for $5.85 each. Okay, and record this sale. So this $5.85 is including freight tax as well, freight charges as well. Okay, so in this case, we need to understand that under perpetual inventory, that there is an additional account that must be calculated. Okay, so this is where it's very important that we understand how to use our inventory worksheet because when we take a look in chapter 8.1, you'll understand because I'll show you the inventory worksheet. But for now, let's just focus on journalizing the sale. So, because we are journalizing the sale, what do we start first? Okay, we're going to recognize the sale first. So we're going to recognize cash. Good. If it's cash or accounts receivable. What else are we going to recognize? Sales. And then what's the last thing too?
Tax.
Yes. So Another thing that I wanted you to recognize is because we have an additional account that needs to be added as well, it's going to be your cost of goods sold. So if we've recognized this, this account before, right? But this time we're going to be applying it to as part of our little section here. So again, here we've recognized that we made a sale. That's the first thing first is we need to recognize the first things first, which is what is a transaction at hand. We made a sale. We got rid of 10 toys. So let's go ahead and calculate it. So 10 toys at $9.99, how much is that?
$99.90.
All right, and how much is the tax on that? $8.24, bringing our grand total to be $108.14. So this is where we're not done yet, because when we're dealing with perpetual sales, there's 2 entries that we need to make. So this is where we're going to actually physically keep track of our inventory. If the inventory originally cost me $5.85, right? How much is it going to take to get rid of 10 of those items? How much is it going to cost you to sell that item? I sold 10 of them. $58.50. And of course, we're going to take it out of our only place that we have, right? When we originally had our purchases of inventory, where did we place them?
Inventory.
We're going to take it directly out of inventory, and it's going to be for the $58.50. So this is how we are going to be recognizing the sale, right? We're recognizing the sale at its selling price, okay? But when we calculate it and take it out of our inventory, right, we're going to take it out based on how much it costs me to sell that item. So $58.50, okay? And we're taking it directly out of inventory. All right? Any questions? So this one we have to really focus, because not only are we going to be calculating our selling price, we're also going to be calculating how much it cost us to sell the item. All right? And that's where we recognize cost of goods sold, which, as if you guys remember from our lecture, cost of goods sold is directly correlated to our inventory. It's pretty much exactly what it says. How much does it cost you to sell that item? We sold 10 of those items, so it cost me $5.85 each to sell one item. So in this case, boom, $58.50, right? Now, if you look at here, right, I obviously made a huge profit, right? I almost made double the money. So that extra profit is going to cover everything else in like my other expenses. But that is how you calculate it. You're not going to calculate your cost of goods sold as your selling price, okay? Reason being is because how much did it cost you? You originally purchased it at a certain price. So when we calculate and keep track of our inventory, we need to subtract it at how much it cost us in order to sell that item, right? Any questions? Okay. Well, that's it for 7.4. Yeah. So that, I mean, again, the same thing with chapter 6. Chapter 6, when we learn sales, all you have to do is recognize one portion. This time, when we're dealing with perpetual, we have an additional journal entry that we need to make sure, because we are keeping track of our inventory, right? And this is, and when we dive into chapter 8.1, we'll actually see how the transaction goes, okay? So here is 7.4. Now, of course, when we have our sales, we also have to remember that we also need to remember that we're dealing with customers. Customers, they have reasons to want to make returns, right? Whether it's they purchase a broken item or a defective item, whether they just don't want it anymore, they're just unsatisfied, or maybe it was a gift and they're just trying to return it or exchange it. Other things too is like they're just flat out unsatisfied. They buy the product, They tried it out, they don't like it, boom, they return it. So with that being said, this is where our company needs to make some kind of policy when it comes to returns, because our ultimate goal is we want to make sure that our products are sold and they stay sold. Okay, that's the part of the nature of doing business, right? You want to make your profits. You don't want to make your profit and then have to return it. You want to ensure that your product is sold. So these policies could include, right, maybe a 14 or 15-day policy, or even 30-day policy, right? Oftentimes, most stores, right, on the receipt, it says that you have X amount of days to be able to return the product for a full refund. Okay, and if you miss that date, usually what happens is it's possible that you could get store credits, or you could actually do final sales, where once you buy the product, that's it. You can't come back and return it. Other things could be you could issue a new product if in case like it truly is broken or defective, and you say, well, you know what, you could keep the product. We'll just send you a new one just to guarantee that you are satisfied. Other things too is you could also have exchanges. Now, with this kind of policy, you have to remember, because the sales tax does not belong to us, it belongs to the customer, right? Until they're completely satisfied, then it belongs to the government. So, because when we deal with the sales returns and or an allowance, we have to also consider giving back the sales tax, because again, it's not based on the product, it's based on the actual amount of sales they actually purchased from you, and it's based on a percentage. Okay, so let's go ahead and practice this little example here, where on May 1st, okay, you sold 50 coffee mugs for $5 each. The coffee mugs cost you $1.25 each. All right. Sales tax is 8.25%. So, and then customer A paid with cash for the mug. So how do you record this transaction? Debit cash. Good. What else?
Sales.
Sales. No. We have to record the sales first in order to do a return.
Okay. Cash sales tax payable.
Good. Okay. Now let's go ahead and calculate that for us. So we're looking at the selling price.
So 50 mugs at 5 is 250.
50 mugs at $5 is $2.50. What else? What else do we need to include?
The sales tax.
Sales tax payable.
Okay, and what is that?
2063.
2063. So then that brings us a grand total of cash of
270.63.
270.63. Okay, good. Now that we established that very first journal entry, we also recognize that we sold some items. Now we need to update our inventory. So what's the next portion that we have to do? If it costs me $1.25 to sell each item, how much is my total cost of goods sold?
62.50.
62.50. Okay, so we have a cost of goods sold, and we have obviously our coffee mugs, and it's going to be for 62.50. All right, and of course, when we have our inventory worksheet, we're going to immediately update our inventory, so we should know how many coffee mugs we should have at the end of the day. Okay, but good. Now, let's go ahead and consider this. Now, the example here is on May 10th. Customer A wants to return 10 coffee mugs for a full refund, okay? And your company store policy was a full refund within the first 15 days of purchase, okay? So the coffee mugs cost you $1.25 each. So how do we record this transaction?
Sales returns and allowances.
We're going to have a sales returns and allowances. What else?
Sales tax.
We have to return the tax that we're returning the item for. And how did the customer pay us originally? They paid us with cash. Correct. So let's go ahead and calculate it. If it cost you $5, or I mean, if you sold it for $5 each, and you're returning 10 of them,
$50.
$50. Okay, and how much was the tax on top of that?
$4.13.
$4.13. So therefore, you need to give them back $54.13. But hold up, don't forget, because we updated our inventory, the assumption here is when we're making a full refund, right? Or full return, what happens to the product?
It's put back in inventory.
It's supposed to be placed back in inventory. So in this case, we need to recalculate and place it back into inventory. So how are we going to journalize it this time?
The inventory and then cost of goods sold.
Inventory and then cost of goods sold. Good. So in this case, it's coffee mugs. We got to place it back into our inventory. Now, of course, realistically, you would never directly place it into your inventory. You would have another account to place it back, right? Usually it's like refurbished products or, used products. So those could be placed in another inventory account, and you're obviously going to keep track of that. But for this is general basic information. So because we had a customer return the product to us, we need to also assume that the coffee mugs are going back into inventory. So if it cost me $1.25 cents each, right? How much is going to be refunded and returned back into my inventory?
$12.50.
Okay, so it's going to be $12.50 because we're returning 10 of those coffee mugs. Okay, any questions in regards to returns? No? No questions? Okay. So now, this is another scenario. So now on May 18th, customer A wants to return 10 coffee mugs for a full refund. However, the customer doesn't like the color, okay, and you tell them that the customer has missed the return policy date, but they're getting super mad, and no matter what it is, but we offered them a 15% discount because we want to keep their business, right? So they're willing to accept the 15% discount. So in this case, how are we going to record this transaction?
Sales returns. Allowances.
Sales returns and allowances, because this is the allowance part. All right. What else are we also returning back to them?
Payable, sales tax payable.
Tax.
We have to return the sales tax. And then lastly, how did the customer pay us?
Cash.
We have to give them back their money. So good. Now let's go ahead and calculate that. If the customer is trying to attempt to return 10 of the coffee mugs, which we originally sold for $5 each, but we're giving them a 15% discount, how much are we actually giving back?
$7.50.
What was that, $7.50?
Yes.
Okay. How much tax are we actually giving back on top of that $7.50?
62 cents.
62 cents. So our total cash that we're giving back is going to be $8.12. Now, question to you. Do we need to add another entry to record that we need to put back the inventory?
No, we can discard.
No, because the customer kept the item. It's still sold. So therefore, because they're not physically returning it to us, we're done here. So that's what you have to also keep aware of when you're dealing with the sales returns and allowances. Did the actual customer return the product to you? If they didn't, then you don't need to update your inventory because it's gone, it's done, it's sold. And on top of that, this type of sales, when you give a sales discount, it's based off of the profit, not dealing with your cost of goods sold. Okay, so in this case, we don't even update our inventory at all. Okay, any questions in regards to the sales returns and allowances?
No questions.
Okay. And of course, when we're dealing with sales, we also have to remember that we also need to provide sales discounts because, again, customers love discounts. They never want to pay for the full price unless they truly want the product, okay? Oftentimes, the way to entice your customers is to have some kind of sale. Oftentimes you'll see sales that are either in store or you can actually personally give a customer a specific discount or an incentive. Okay, so the common ones that we see are usually promotional sales for in stores, promotional sales, weekly ads, special discounts, or even online discounts, online deals. Okay. Other than that, the other discounts that we normally see is usually if you, again, if you give a customer terms, right? You're giving them an incentive to pay you back. Or if they buy in bulk from you, right? Then yeah, sometimes you can give a friendly discount, like saying, oh, if you're going to buy more than 20 of the same exact product, I'll give you an additional 10% discount because you're buying in bulk. Okay? Etc., etc. So again, customers love sales. So we need to consider, well, what happens when we do, for the first example, an in-store sale? Okay, so here we have here on June 1st, your store is having a promotion on all items are 40% off. All right, and a customer buys 10 baseball hats, okay, which with cash, which originally the price sale for it is $10 each. Okay, sales tax is 8.25%, and the hats cost you $2.50 each. All right, so let's go ahead and record this transaction.
Debit cash.
We're debiting cash. Good. What else?
Sales
Credit
discount.
sales.
What was that, Nilo?
Credit sales.
Okay, so so there is a sales discount before we do credit our sales, but credit sales is correct. What else?
Sales tax.
Yes, we also have to include the sales tax. So again, just like we looked at the previous chapters, how are we going to calculate our sales? How much is we going to calculate our discount? How much tax is going to be on there? And lastly, what is our total cash that we're going to receive? So let's break it down. So what is our first one is how much sales did we actually made?
$100.
We made $100 because we sold 10 hats at $10 each. Okay. How much is the sales discount?
$40.
It's going to be 40% of our original price, which we know to be $40, right? 40% of $100 is $40, right? How much tax are we actually going to be calculating?
$4.95.
$4.95. So in grand total, how much cash should we be receiving?
$64.95.
Okay, so there you go. So here you go. We calculated $100 is our original sales price. We discounted it by $40, bringing our now amount to be $60. We're going to multiply it by the tax to get the $4.95 to give us a total of cash to be $64.95. Okay? Now, again, we just had a sale. So how are you going to journalize the next part?
Cost of goods sold and inventory the hats.
Yes, good. Cost of goods sold and hats. All right, so let's go ahead and review. How much is going to be your total cost of goods sold?
$25.
Good. $25 because we sold 10 and it cost us, right? We originally purchased it for $2.50. And now when we get rid of it, we're going to sell it at, or we're going to cost it at $2.50. So there you go. So $25 even. Okay. And that's it. All right. Now the next portion here is because we've already seen this before. This is something that happened in chapter 6. So we know what to do now. So this part is going to become a lot more easier because we know what happens now. So now here on this, so now we're going to be looking at a purchase on an account, and we're going to give this customer terms, okay? So this example here is on July 1st. A customer wants to buy in bulk 100 baseball hats from you, okay? And he wants to buy it on an account. All right. And because the customer is a first-time buyer, you offer the customer a 5% discount if they pay you within 15 days. And if not, they have to pay you in full for 30. Okay. And of course, each hat that was sold was originally for $10 each, as we know from the previous section. All right, sales tax is 8.25%, and there was a delivery charge because obviously we're not gonna have 100 hats available of $10, and each hat cost you $2.50 each. So let's go ahead and record this transaction.
Accounts receivable.
Accounts receivable, good, because we placed it on an account. What else?
Sales.
Sales and what else?
Sales tax.
Sales tax.
And delivery.
And delivery charge. Good. Okay. We're not taking the discount yet because the customer has not paid us yet. Okay, so that's one thing that we got to recognize is that we're just recording the sale, the transaction that a sale has happened because essentially we're going to be shipping them out. Okay, they paid us, or they're going to pay us on an accounts payable. All right. So let's go ahead and calculate this. What is the total sales? Sales tax and delivery. $1,000. Good. How much is the tax?
$82.50.
Okay. How much is the delivery charge?
$10.
$10. So there you go. Total is going to be $10.92.50. All right. And then because we made a sale, what else do we have to recognize?
Cost of goods sold.
Mm-hmm. And what else?
Inventory hats.
Good. All right. How much did it cost us to sell each hat?
$250.
Good. So what's our total cost of goods sold here?
$250.
$250. Good. All right. So here's scenario number 1 is on July 12th, the customer decides to pay us for their purchases in full. Okay. So let's go ahead and record this transaction. All right. The terms was 5%, 15, net 30. So how are you going to calculate this time, and what is my journal going to look like?
Cash.
Okay, good. Cash or yes, cash or checking, whichever way this customer paid us, right? He's paying for the products he sold, or the products I sold. So good. Cash. What else?
Sales discount.
Sales discount. Good. What else?
Tax.
Yes, you have to give back the tax. All right, and then what else?
accounts receivable.
Yes. So there you go. Okay. So you got cash, right? Because you're receiving a payment. You have your sales discount, which is the 5%, and then you have your sales tax payable because you are discounting the items. So you have to give a portion of the money back. And of course, you have your accounts receivable. So let's go ahead and break it down. How much was my discount for?
50.
50.
50. How did you get 50?
It was $1,000 for the 5% discount.
Good. Okay. How much
The payable.
tax? Good. How much tax are you going to pay on that?
$4.13.
Good. How much cash in total should you be actually receiving? All right, let's start off. How much total amount does he owe you? I'll go back if you need help.
$1,092.50.
Okay, so how much cash are we actually receiving?
$1,038.37.
Okay, good. So this is how we're going to calculate it. We figure out the discount can only be on the original selling price. It cannot be on freight, shipping, delivery charges, or even tax. Okay? And because we're refunding $50 of it, we need to calculate the sales tax based on it. And of course, how much does he originally owe me? He originally owes me $92.50. However, I'm discounting him. So that means this person is going to give me a total of $1038.37. Right? All right. And because I have this, do I need to include my cost of goods sold or anything like that?
No.
No, that's it. Okay, no cost of goods sold because you're just taking a discount. Discount does not affect your inventory at all because this is a sales perspective, right? You're only taking a discount off of your profit. You're not taking a discount off of what you sold or your cost of goods sold. Okay, that's only dealt with purchases. So again, chapter review. We got to take a look at how we journalize our sales, right? We recognize that when we make our purchases, it's going to go straight into inventory. When we make our sales, it's going to be taken directly out of inventory. So when we do our sales, we have two journal entries. We need to recognize first the sale, and then we also need to update our inventory by having a cost of goods sold. And this happens every single sale that we have because we're constantly updating our inventory, okay? And of course, all costs are going to straight into inventory, and that means all costs are coming out directly out of inventory, okay? Other things that we got to take a look at is what happens when we have a sales return. So again, if you do have a sales return, you're going to return the product. If it's an allowance, then you only return the amount of whatever you give them back, okay? And of course, we took a look at discounts where we looked at in-store versus terms. In-store, again, happens right then and there, whereas terms, you have to wait till they pay you and then record the discount then. But if not, if they missed it, then they just pay in full. Pretty straightforward. All right, other things that you need to know is that sales are recorded at full selling price, okay? No matter what it is, even if you have a discount, you need to recognize that sales is always at full price. All right, and on top of that, sales tax and delivery charges, etc., can never be discounted. All right. All right, any questions in regards to chapter 7.1?
No question.
Okay. All right, so then let's go ahead and do our exercise here. So here's exercise 7.1. 7.4 all the way to 7.6. Okay, so again, here, journalize, all right, and assume that sales tax is 8.25%, and your purchase of is a total you purchase a total of 500 cups with all costs equaled to $1.36 each. So that's your cost of goods sold that's each item that when you sell your item, it's going to cost you $1.36. So that's including, this is the original purchases that you've made. Okay. So let's go ahead and take a look at our first sale here. On April 5th, okay, you sold a total of 100 cups at $5 each to customer A for cash.
So is cash.
Is cash.
Sales.
You got to recognize your sales.
Sales tax payment.
Sales tax.
Okay. And what are those amounts?
$500 for sales.
41. Sales 500. 41.27. Sales tax.
Okay, so what is my total cash I should be receiving?
541.25.
Okay, good. And then I'm going to make a note here that I sold what is it? 100 cups to customer A. All right. What else do I have to recognize?
Inventory.
Okay. How are you going to do that?
Cost of goods sold.
Cost of goods sold. You have to remember. Okay. And where are we taking it out of?
We're taking it out of what we paid for $1.36.
Okay. I meant what account are we going to be taking it out of?
Inventory.
Inventory.
Okay. In this case, my specific inventory is
Cups.
cups. Yes. All right. And how much is my total going to be here?
136.
136. Good. Now you could either put the description below here, or you could keep it up here. I just want to make sure that I sold it to a specific customer, and of course I'm just going to cost of goods sold. It doesn't matter how many I sell, okay? Because I know how much I sold it for. All right. Then what has happened next? On April 7th, you sold. Okay, I sold 25 cups at $5 each to customer B on an account. Okay, and I gave him terms of 10%, 15, net 30.
Accounts receivable.
Okay, so good. So accounts receivable.
Sales.
Sales.
And what else?
Sales tax.
Sales tax payment.
Okay. And how much was my total sales?
112.2.
125.
Oh, okay.
125. So 5. So 25 times 5. Okay. What was my tax I have to pay on that? Or the customer has to pay on that? What was that?
1031.
Okay. And what is my total cash or cash that they owe me or money that they owe me?
135.31.
Okay. And of course, I'm going to make a note here that I sold 25 cups at to customer B. Okay. And what else do I have to recognize as well?
Cost of goods sold.
Yes, we also need to recognize our cost of goods sold. And what else?
Inventory, cups.
We also have to recognize our inventory, which was cups. Okay. And how much is my cost of goods sold going to be?
34.
$34.
Mm. Okay, good. All right. And then what has happened next? So we have here, April 10, you sold an additional 50 cups at $5 each to customer C for cash.
Cash.
Yes. We're going to recognize, what's the date for this one again? April 10. We sold cash. What else?
Sales.
What else?
Sales tax payable.
Okay, how much was my total sales going to be?
250.
250. And how much tax is going to be on top of that?
2063.
90.63.
20.
No, 20. 20.
Okay, bringing my grand total to be
270.63.
good. And I'm going to go ahead and write right here. All right. Don't forget, we have to also include our cost of goods sold. So what was our cost of goods sold here?
$68.
What was that, Daniel?
68.
$68. Okay, and of course, we're going to update our inventory, which was the cups. All right, we sold 50 of them. Okay. Now, here's another scenario here on April 15. Customer A decides to return 10 of those cups for a full refund.
So returns and allowance.
What kind of returns and allowances?
Sale.
Sales, good.
Payable.
What kind of payable?
Sales tax.
Yes, we also have to refund the sales tax. Okay, and then lastly, how did customer A pay us?
Cash.
They
Cash.
paid us in cash. Good. So, how much, since they're returning 10 of the items to us, how much in total is going to be refunded?
50.
Good. And how much tax is going to be refunded?
$4.13.
Okay, giving us a grand total of 54.13.
13.
Okay. Okay. Customer A returned 10 coffee 10 cups for full refund. Okay. So what happens next?
To adjust the inventory and the cost of goods sold.
Good. Thank good. Okay, so we're gonna so we're gonna place it back. We're gonna place it back into our inventory, and we're gonna adjust our cost of goods sold because they actually physically return the items to us. All right. So what is the amount that I am actually returning back into my inventory?
Yeah, 1360.
1360. Okay, good. Now here on April 20th, customer C decides to return 25 mugs, but is willing to accept a 15% discount. So, how are we going to journalize this?
Sales return.
Sales returns and allowances, good.
Siya. Sales tax
So
payable.
discount.
Not sales discount. He's attempting to return the item.
Sales tax payable.
So here you go. Hold on there. Let me finish writing that. Sales returns and allowances. And you said you got to give back the sales tax payable. Good. And how did customer C pay?
Cash.
They paid with cash. Good. So let's go ahead and calculate this. If they were decided to return 25 of the items, but only is willing to accept a 15% discount, how much total is he actually going to get back from us?
$18.75.
1875. Okay. Oh, ha 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 ha. How much tax is on off the 1875?
$154. 155.
120.
155?
Yes.
Okay, bringing our total to be
2030.
20. Oh, wait, what? 2030?
Yeah, $20.30.
Okay. All right. And I'm going to go ahead and say customer C return 25 cups at 15% disc. Okay. All right. Question to you. Are we going to update our inventory?
No.
No.
No. Yes, because
Yes, anyway.
they kept the product. So good. All right. Last but not least, on April 22nd, customer B decides to pay for his purchase and he meets the discount. So let's look at customer B. How much did customer B buy from us?
25 cups.
he bought 25 cups. So here, let's look here, accounts receivable. So he's paying in full and he gets a 5% discount. So what are we going to be calculating here? What are our accounts going to look like?
Cash. No.
Cash or checking, depending on how he paid us, right?
Uh, sales.
Sales.
Okay, we got the sales tax payable, okay. What else are we recognizing?
Discount.
Discount.
Yes, we also have to recognize the discount, all right? And then lastly, what is our last account that we're going to be recognizing?
Accounts receivable.
Accounts receivable, yes, because we need to decrease the amount that he owes us, right? Because he no longer owes us. He paid it off. So my total here is going to be the 35.31. What is going to be my discount amount?
$13.53.
So go ahead, sorry.
Yeah, we talk about customer bill, right? I will be close.
Yes.
Discount is 13.53, right?
What? How did you get 13.53? That's 10%. Did I give him 10%? Sorry.
Yes.
Yes.
10%.
Okay. So okay, let's try that again because that's also including sales tax. What can we discount when we give a discount?
125. 125. Yeah, we discount just 120.
Correct. And 10% of
1250.
12.50. Correct. Okay, so there you go. So 12.50 is our discount. How much tax can we is on top of that 12.50? Sorry, what was that?
103.
103. So then how much total cash am I actually going to be receiving?
$121.77.
121.77. Okay. All right. And of course, my last note I'm going to write here is that customer be paid. And 10% discount. Okay. Good. So there you go. We got to take a look at an example of how we dealt with sales and how it affects our inventory. So now chapter 8.1 is going to make a lot more sense when we look at our inventory worksheet because when we're going to be doing our chapter 8 review, we're going to go back and forth to realize what it is that we need to do when it comes to journalizing using the inventory worksheet and then going back to our inventory worksheet, okay? So good job, everybody. So it is now 9:27. So let's go ahead and take a 20-minute break here. I'll call it at 9:30.